Global equity markets had an exceptionally strong year. They were up about 37% in Australian dollar terms up until August. While that was strong from an underlying equities perspective, a lot of that return did come from the weaker Australian dollar. The Australian dollar lost about 15% against the US dollar, and it lost about 22% against the euro. Really the only currency that it was strong against was the yen, which was only up about 5% against that currency. In terms of regions, Japan was the best performing region. It was up strongly, up 50% in local currency terms, and a lot of that performance was driven by excitement about reform policies that are really aimed at tackling long-term deflation in that market. Developed markets in general did significantly better than emerging markets. Emerging markets underperformed by about 20%. They were really impacted by rising bond yields in the US. The talk of quantitative easing coming out of the US market was pretty much the driver of that. And really capital outflows that were coming out from the region were quite painful for those markets. In terms of outlook for the next 12 months, while there are sort of things that we kind of seem quite positive about in terms of outlook, things like recent improvements in Europe and signs that sort of growth is at least not as negative as what was occurring previously. Even China has rebounded more recently, and then there are signs that the sort of US growth is on a more sustainable path. These are all positives for the markets going forward, but we still think that there are a number of risks that warrant us to be quite cautionary over the next 12 months. One of those is valuations. While are cheap relative to bonds and cash, they are still quite not really cheap relative to their own history. And most of the recent performance in markets has been driven by really valuation expansion as opposed to improvements in earnings. In fact, earnings growth has continued to decline over the last couple of years, and we kind of really still expect that to continue in pace, although reduce and somewhat moderate over the next 12 months. Other risks that we kind of see on the horizon are really more. We're coming up to sort of, again, talking about the US debt ceiling, and there's going to be lots of wrangling around that. So these are all sort of short-term risks around that market, but we expect an outcome from that, and that shouldn't be a long-term issue. Also risks around Syria, while that's reduced more recently, really that still has the ability to destabilise that region, especially if places like Iraq and Iran also get impacted by any potential US military strikes. And still political risks within Europe are always there, and Japan in terms of its reforms, where that sort of goes to over the next 12 months is also a risk. So I think there are things to be positive about, but also there are enough risks out there, and in an environment where valuations are pretty much at full value and not really cheap. We think that really what we've had a sweet spot of stronger growth and cheap valuations, that sort of easy period is over, and it's a bit more of a period which is going to be driven by differentiation across markets. And I think while that's not great for really strong returns, it's probably good for active management. Despite sort of recent trends over the last 12 months and potential for reversals, and we have seen emerging markets do a little bit better over the last 2 months, we still expect developed markets to be substantially better than emerging markets in the near term. And really that basically we continue to expect gradual improvements in developed markets from an economic standpoint, while at the same time emerging market fundamentals seem to be deteriorating at this point in time. So the positive trend in the developed markets and the negative trend in emerging markets is we still kind of expect that to play out from an expectation standpoint. Within developed markets, in the near term, we probably actually like Europe at this stage. Recent signs of improvement in growth there, and the expectation that while austerity is still going to be in play, we think the severity of the austerity will be reduced, and I think both of those aspects have the potential to really surprise positively on an economic standpoint. And with earnings being somewhat 35% below their peak levels compared to other regions, we think that that really sets up a positive platform for potentially strong returns should these positive trends continue. Within emerging markets, we kind of still expect pressures from outflows in that region, and a lot of those outflows and pressures on really growth and inflation, a lot of that can be self-reinforcing, and at this stage, the recent negative volatility that has occurred in those markets, we think that really poses still a structural challenge in the near term. Longer term, the cheaper valuations that are coming out of emerging markets will be a potentially good thing to allocate to at some later stage, but right now we would still looking to avoid emerging markets. There are a number of influences that we are concerned about at the moment. One of those is the recent rise in US bond yields, which has been sort of steadily rising over the last 4 months as expectations of the US reducing its quantitative easing. And bond yields, in fact, early this month hit 3%, which is the first time in 2 years that it's hit that level. And while at this stage not really constraining on financial conditions, any further sort of rise from here or sharp rise from here would be certainly concerning for us, and so that's something that we continue to monitor. The backup in bond yields has also impacted certain parts of the market, so the more defensive, higher yielding components of the market have, while they performed well early in the year, have all sort of been pulled back more recently as bond yields have risen. And I think any move here from bond yields is something that clearly is an important component as to whether or not what equity markets will be producing. I think also something that is probably on a more positive front is recent positive surprises from Europe and Japan, and even China more recently producing better sort of economic numbers, signs of US sustainability and growth. So these are, if these trends continue, this is a positive trend that we would like to sort of see. On the Japanese front, I think there's still risks around Abe and his policies going forward. There's lots of positive excitement around these reforms in tackling deflation, but a lot of these reforms are actually quite opposed by his own party within Japan, and any failure to sort of come out with some credible policies in the near term, I think, will be subject to sort of risk for the markets, and markets have, to a certain degree, already starting to feel a little bit more concerned about where Japan goes from here. The Syrian sort of issue there, while that's been reduced more recently and there is less expectation of a US military strike, I think that risk has certainly not gone away for now, and that certainly has a potentially negative impact from higher oil prices, which is somewhat a constraint on global growth if it was to allow to go quite highly. A couple of the themes that we're seeing developing is the environment has been very much driven by macro influences, and I think that has been a function of a lot of the conventional and unconventional policies that have taken place over the last couple of years. Really, the correlations across stocks have been quite high relative to history, and that has made it quite a difficult environment for bottom-up stock selection, which have been mainly driven by kind of macro influences, and that has sort of left to a lot of active managers doing quite not so well, But we do see that there are signs of improvements in that space, and I can see stock picking doing much better going forward. The kind of severity of the macro data and influences is starting to come back. The intra-stock correlations are starting to come back to more normal levels, and I think that bodes well for active management going forward. The other theme that we're seeing, which seems to be developing at the moment, is the case for more corporate activity. At this stage, in this bull market cycle, it's really been missing compared to sort of the periods like 2005 and 2000 and 2003 to 2007. While the markets have been positive, there have been a number of macro influences which have really impacted corporate confidence and therefore have not really led to the same M&A activity or corporate activity as we have seen in previous bull markets. But I think at this stage of the cycle, as the market is more mature, earnings are a little bit more under pressure, and there's pressure from shareholders for management to deliver improvements to growth. I think there's certainly the pressure for management to do something, but the environment is also conducive for management to do something. So we have lower volatility, we have tight credit spreads, we have reduced sort of macro influences, we have high cash balances, good corporate balance sheets, and so we think there are a lot of positive attributes at this point in time which points to us being more confident about corporate activity going forward.